Analysts, as one, said buy Woolworths, sell Coles today after their annual results, even though Woolies is already selling at a 20% premium to Coles. This graph shows their price-to-earnings valuations, which parted 2 years ago when Woolworths reported a 23% lift in profit and Coles only managed 7.5%. And they've stayed apart ever since. And in fact, they widened a bit today, with Woolworths up 3.5% on the back of its latest results and Coles down some more on top of yesterday's 7.1% plunge following its results. But today's clean-up on aisle 3 was WiseTech Global, down nearly 20%, as investors questioned the validity of its name, after CEO and founder Richard White confessed that margins have been squeezed by low-margin acquisitions. But there were some good results from Macmillan Shakespeare and Domino's Pizza. Global markets mostly fell after a drop in New York. The Australian dollar was steady at 64.4 US cents. And there was a wave of buying on metal markets after Beijing stepped in to support the Chinese currency, followed by forecasts of stronger demand from China. It was the first bit of good news about China for a while. Markets have been focused on the fact that China's debt has caught up with that of US, Europe and Japan at around 300% of GDP, which is not ideal. And it's related to the decline in consumer spending relative to household income. China's outsized economic growth has had to come from debt-funded investment in apartments, many of which remain empty. And it's the indebted developers now that are facing demolition. And that's finance.